That 2.6 trillion is going to be over 60% of projected global GDP growth next year.
Oh my God.
There's no freaking balance sheet. And this is what people like, this is the elephant in the room, like the elephant on top of the elephant on top of the elephant in the room. There is no fucking balance sheet.
So everyone, welcome back to Futures Now. I'm Jim Urio. As always, Bob Iacchino, the brains behind the operation and the host. And today we have Luke Gromen, who is the founder and president of FFT and the author of 2 books. What are the name of the books, Luke?
Originally named Mr. X Volume 1 and Mr. X Volume 2.
Great.
Clever names. yeah, good job on that. Okay, so just because you're sophisticated and above our head does not mean that you don't have to play the same silly games as all our other guests do. So we like to establish credibility at the beginning with a series of questions. You have 5 seconds to answer. You will be judged harshly on your answers, just to be clear, okay? Nobody knows what the questions are, including me. Go. If you're going on a vacation today, where's the #1 spot you'd want to go?
Lugano, Switzerland.
Nice.
That's
A
interesting.
lot of gold
Okay.
there, Luke, isn't there? A lot of gold in Switzerland.
Hey, we're going to talk about gold. We're going to. By the way, is that a skiing destination?
No, I've heard good things from friends whose opinions I trust.
Very cool. What's your favorite movie?
Field of Dreams.
Nice.
Oh, nice.
What a good call that is.
Your favorite drink?
Probably.
Be swayed by what I have in my hand at all.
Yeah, right. I'd probably have to say a nice glass of Cabernet.
Nice. Okay, and the drink thing was a hard question for me because normally I have a beer, Bobby has a bourbon, but I've been at a conference down in Miami for the last 2 days, and I've been winged all day today. So if I'm not on my game, I'm gonna have to run out of here a couple times.
It's an old fashioned. If my wife was home before the podcast, she makes a wicked old fashioned. Otherwise, it's a straight bourbon, which means I'll be making sense through most of the podcast because it's not a straight bourbon.
It's good. Where are you located?
Cleveland, Ohio.
Oh, very cool. Good. Okay, so we're going to start right out with some things that were tweeted today. The conversation between you and Keith, which was about gold, which is about oil, which is about a lot of interesting things. And I think a lot of people were, it's a pretty high level stuff. Do you think you can simplify for us what the argument is?
Absolutely.
Good. Now?
I'm sorry. Now, which argument in particular?
Roll the tape over again. No, I'm just kidding. Whichever. That's it. The ones you think is the most pertinent right now, because there was a lot of content that came there.
For gold, you mean?
Yeah.
Yeah, I think the argument for gold is pretty straightforward. You have I think 2 major factors. You have the incumbent reserve asset of the world are U.S. Treasuries. They are negative real interest yielding bonds issued by an insolvent sovereign. And you have an insolvent sovereign issuing these. When I say insolvent, what I mean is that the United States debt load and deficit is so high that the United States has to have negative real interest rates just to avoid a financial crisis. So number one, negative real interest rates are really good for gold. Structurally, they need to be just to keep the incumbent reserve asset of the world, Treasury bonds, nominally money good. Number two, you have a situation where the world is moving into what I call peak cheap energy, which is we're not running out of energy, but we are running out of cheap energy. And so energy prices need to rise secularly just to keep generating increasing production of energy that we need to generate the economic growth to keep all of the debt pile we have sustainable. So that creates a problem back for the world's incumbent reserve asset treasuries, because if you want to hold assets as your reserve asset as a sovereign that are negative real interest rate relative to CPI inflation, and which are going to decline, they better decline relative to oil prices secularly, otherwise we're not going to find enough oil, the system's going to be collapsing, then you're an idiot, basically. No one can afford to do it. There's basically, there needs to be a sucker at the table to the tune of whatever, we're going to issue, 1.3 trillion deficit this year. It's going to be closer to 2 next year. There has to be a non-economic dumb buyer of $2 to $2.5 trillion next year of U.S. Treasuries to finance our deficits, negative real interest rates and negative real interest rates relative to oil. And so as a result, you're seeing global sovereigns switch to gold. You can go back over time. Since 1870, it took 24 barrels of oil to buy an ounce of gold. In what are we? We're not in 19s anymore, are we? Sounds like I've already been drinking. 2022, it's 20 barrels of oil to buy an ounce of gold. In contrast, in 1970, a treasury bond bought you 100 barrels of oil, $1,000 face value. Today, it's 16, 18, and that's going to keep going down. So you're seeing the world just say, look, I can't, do I like the US? Do I not like the US? It doesn't matter. They can't afford to store their wealth, their surpluses in sovereign debt, period.
Okay, so here's this then. So you're saying the world's not going to buy U.S. Treasury bonds. Okay. Well, then what will the Fed start buying? Will the Fed start buying U.S. Treasury bonds again? Or don't a lot of pension funds have to have Treasury bonds? So how does that play out?
Sure. So there'll always be a buyer for Treasury bonds. It's a question of dollar price, with international trade value of the dollar, right, and the rate on the bonds. So we have seen this regulatory capture, if you will, or this regulatory forcing. It started back in 2014, where banks had to buy more treasuries for high quality liquid asset, regulation purposes. You saw money market fund reforms, where money market funds were encouraged via regulation to switch from private money market fund assets to government money market funds, which were T-bills. And so this game plan, the pensions, et cetera, this has sort of been underway for the better part of a decade. Ultimately, someone will buy them. Historically, we have seen any time the U.S. fiscal deficit is more than 20% of the nominal growth in global GDP in dollar terms, the Fed has come in and done QE. That going back 27 years, back to 95. Anytime U.S. deficits are more than 20% of global GDP growth, the Fed has basically helped buy treasuries, because otherwise you get into this situation where U.S. deficits crowd out global dollar markets, dollar goes up, stuff starts breaking in the periphery, then it breaks here, and then the whole system comes unhinged. Okay. There's one exception to that. I think it happened, 8 times maybe in 27 years. Of course, 08, 9, 10, 11, 12, 13, 19, 20. There's one time it didn't happen, 2022. US deficits were 33% of global GDP growth, and what'd we get? Dollar up, oil's flat now. Everything else down, treasuries down, stocks down, real estate down, inflation. Okay, so in 2022, US deficits were about 33% of global GDP growth. Right now, assuming the IMF's GDP growth estimate for 2023 holds, and I would take the under, but separate discussion, they're looking for 2.7% growth globally. Right now, if you annualize the just updated US fiscal deficit estimate for the next 6 months, and you annualize that, you get 2.6 trillion. That 2.6 trillion is going to be over 60% of projected global GDP growth next year.
Oh my God.
There's no freaking balance sheet. And this is what people like, this is the elephant in the room, like the elephant on top of the elephant on top of the elephant in the room. There is no fucking balance sheet. And so either the Fed's going to come in and finance this stuff, to your point, Jim, or if you liked February through September, where sort of the dollar goes up non-linearly and everything else breaks, you're going to love 2023. It's going to be a shit show. And treasuries aren't going to save you. They're going to go down too.
Bobby?
Do you think this has to happen in 2023, or that's just kind of your timing of it?
Oh, yeah. I think it's one of two things going to happen. The Fed's going to QE with CPI still inflated, or shit's going to break like in a way that makes last year look like a tea party.
So it sort of fits in. One of the things that I've said lately, Jimmy, and I haven't said this to you yet, is my base case has moved from the Fed's going to stick, which for a while I thought they would, to the Fed's going to talk about how increased wages now make it okay to have a 4% target or a 5% target. And that's going to be crap. The market's not going to buy that. I mean, the market's going to see right through that the Fed has basically capitulated. So this all started, I mean, was all of this kind of your point, Luke, from your tweet? You tweeted out a Reuters story talking about Ghana buying oil with gold. And people kind of came at you and said, this is actually a good strategy. And it seemed to me like you were saying there's not enough gold to do that.
Oh, no, there's enough gold. Oh, there's enough gold, but not at $1,800.
Okay.
So I think it's, you know, that's sort of this other angle too, and it ties through what we were talking about before, which is the stronger dollar, peak cheap energy. All of this is incenting moves to gold in a number of different ways. In Ghana's case, it's incenting a move towards gold out of national security, right? So you've seen the Ghanaian, I forget what the currency is, but it's down whatever 60% against the dollar this year. Or the IMF's in there. They've got problems. Okay. There are two things when you're a developed or emerging market that blow you up, right? In terms of your balance of payments. Stronger dollar, and so the dollar rises. You've got dollar denominated debt, and you can't make the pay. You know, the debt service cost in local terms goes up. You have to then cut back your local economy to service your debt, put you into a debt spiral because, you know, trying to save money it doesn't work. That's the first way it gets you. The second way it gets you is energy is, for the last 50 years, only been priced in dollars. So not only does your debt service go up when the dollar goes up, if you're Ghana or a whole handful of other EMs, your energy cost goes up. So now you have to cut back on your economy to pay your debt, and you've got to cut back on your energy purchases because your local is falling. Your energy prices are rising in local terms. So you go into this economic death spiral. You can't do anything about the debt. You can't default on the debt. You owe the dollar debt. However, if you can find an energy supplier who's willing to take gold, that gives you a lever to manage the dollar obligations as it relates to your energy. And for most of these EMs, the biggest source of outflows by far is energy and commodities in dollars. So if you can switch it to gold, then great. Now all of a sudden, you just got to find a couple big oil suppliers willing to sell it for that. And suddenly the dollar outflows associated with your energy bill go away. I know your balance of payments improves massively. And suddenly you can keep growing your economy and still pay those. It strengthens your position, your balance of payments and your position vis-a-vis the Americans and the dollar enormously. And so you can understand why there's certain interest in Washington that want to keep gold prices low. Because if gold prices rise enough, then gold can be used to basically strengthen these countries' balance of payments. So who do we know is willing to sell, what oil producers are willing to sell oil for dollar or oil for gold? And
I know this one.
I know this one. So here we are, right? And oh, looky here, there's a war on their borders, right? Oh, surprise, surprise. Now, I think there are other issues associated with that. But when you read stories like, hey, in April, there were discussions of a ceasefire being discussed, and stories that Boris Johnson, acting at the behest of Washington and London, said, no ceasefires. You know why? You know, there's this massive economic issue. So you need higher gold prices, you know, because the energy markets globally are 15 to 20 times the size of the physical gold markets globally, right? So you've got to make gold a lot bigger if you want to use it as a trade settlement mechanism for energy. The higher the dollar goes, the more pressure it puts on EMs, the more the world is going to want to take part in this deal, which is great. I'm facing this dollar squeeze, this dollar milkshake, and the way I can get out of this is I shift my energy. I'll settle it in gold. And now I can negotiate with my energy supplier, if I have such an energy supplier, of, hey, you know, Mr. Russia, can we, you know, right now, COMEX, NYMEX gold to oil ratios, you know, call it 22, right, for round math, something like that. 22 barrels per ounce of gold. Okay, great. If I'm Ghana and I go, can I do it for 30? And if you do it for 30, Russia goes, yeah, sure, that sounds great. So now let's think about this, right? Ghana does it. Ghana can go out, they short they can short oil at 30 barrels an ounce, right? They take the dollars, they buy physical gold, they buy the physical gold, they take delivery, they take the gold to Russia, they get their 30 barrels, or excuse me, they short it at COMEX NYMEX, sorry. They short it at COMEX NYMEX at 22 barrels an ounce, right? Take the dollars, buy the gold, take delivery of the gold, take the gold to Russia. Go to Russia, say, okay, here's the gold you said you'd do for 30 barrels. Great. Russia gives them 30 barrels for that gold. They bring the barrels of oil back. They cover the 22 barrels short, and they have 8 free barrels.
Called arbitrage.
Over and over and over. And now guess who's in charge of the whole shooting match? It ain't Washington, it's Russia and the gold to oil ratio. And gold is the reference asset, not the dollar.
So currently right now, and I'm guessing gold is about an $8 trillion, $9 trillion total market cap, known gold. Is that correct?
Yeah, I want to say it's like 12, but yeah, you're in the neighborhood.
12. Okay, I'm in the ball.
Like that. Oh, if that's
Okay, so-
everything discovered at all times, right? So a lot of that's gone. So it's probably 10. Say 10 for easy.
Okay, let's just say 10 because it's an easier number. So what are you saying then? What are you saying then? If all of a sudden, because then gold, then there's other elements when gold starts to appreciate too, as we've seen in Bitcoin. Speculators flock in, so market position starts to change things as well. So you're talking like a 3x move. We're talking about the next couple of years, right?
I think it could be even bigger than that. I mean, you could say, historically, prior to 1989, when the Berlin Wall came down, USSR broke up. If you looked at the US's official gold at market value, which is like 8,100 tons, times the market price of gold, that value was never less than 20% of the value of US foreign held treasury bonds, treasury debt outstanding, right? So basically our foreign treasury held debt was never collateralized at less than 20% by our gold. And when there were really, really big questions about the dollar in 1980-81, that was 130%. Now that's a gold bubble. When US gold is 130% collateralizing your foreign held treasuries, right? That's you 130% back foreign debt. Like you should be buying treasuries all day long. 15% coupon, 130% backed by gold is a friggin' layup, right? Okay, so by way of comparison, today that number is 6%. So just to get back to like the low end of the historical range, assuming no questions about the dollar, no shifts in reserves, anything, would require about a 3.5x move in gold. Obviously, if there were real questions about the dollar, to go back to where it was in 1980, it'd be a 40x, 20x move, right? Roughly 22x move. That also doesn't include the $12 trillion in FX reserves that are out there, mostly dollar denominated, that you would expect to see bid for gold increasingly if gold moves back into the system as an energy settlement asset, because energy prices will be falling in terms of gold, right? So if you go 22 barrels an ounce, 30, 35, it's not going to take too long before people go, wait a second, gold buys me more oil? Awesome. Buy me more gold. And that also doesn't include any of the leverage implied in unallocated gold markets in London, which have been estimated at, pick a big number, 10 times, 20 times, 100 times, who knows? Nobody actually really knows. And other sort of derivative markets. So 3 times I think is very conservative. Yeah.
Interesting. So before I want Bobby to ask the next question,
Yeah,
but
go.
you said the dollar milkshake. Do we have to give Brent Johnson royalties for that? Or is that your term? Are you claiming it as your own, or are you giving it to Brent?
It's his term. All credit goes to him for coining it. He and I have had certainly a number of good dust ups on Twitter around some of the dynamics of it. I don't think we're that far off of understanding of the dynamics of it. I think our disagreements are largely semantic in terms of some of the geopolitical implications and puts and takes and correlations and causations, et cetera.
Bobby?
I want to take it back kind of 30,000 foot view, because obviously we're talking at the end of the year. So a lot of people are going to be listening to this and say, well, am I to assume that he thinks, okay, let me back that up. I said on, I think it was Bloomberg the other day, I had a guest spot on Bloomberg. And I said my target for gold was 2,800 for 2023. And they went nuts on me. They went nuts on me. Now, if I explain the step up, I think it's going to be 1844 first and then 1901. And I've got the way that we trade at Pat Trading Partners is essentially a target doesn't necessarily mean we exit a trade, but target is a place where an action is needed. So whether it's risk reduction, adding to, cutting back on the position, whatever, it's all pre-planned out. 28, they said, what's your ultimate target? Is $2,800. By next year, I went, sure. Because I hate when they do that. It's like,
Yeah.
you're going to have me on 7 times next year at least, where I might change my mind.
Yeah, exactly. Right. Yeah.
Is your base case that gold is going to hit a much higher level in 2023, that the Fed's going to do QE, or both?
I think gold's going a lot higher, and I think the Fed's going to do QE. Yeah, I guess it's both.
It's both.
The fiscal situation is what it is, right? Like,
Sure.
everybody's been talking about, oh, the asset bubble and the inflation bubble, right? And yes, nobody's been talking about that the everything bubble drove a tax receipt bubble, and the everything bubble has now burst.
Oh,
And the
you're
tax
killing me.
receipt bubble is now bursting too. But what's not bursting is, the $3 trillion check we have to write boomers next year for entitlements, cash out the door. That's 70% of tax receipts. That, in fact, that number's cost of living is 9%. It's cool at 9%.
People really talk about mandatory payments being the biggest problem, and they're mandatory, for fuck's sake.
Oh yeah, I mean the mandatory, just Treasury spending and entitlement pay-goes, I think are soon going to go back over 100% of tax receipts. And that then gets back to that dynamic I talked to before, where there's not the global balance sheet. If just your interest payment equivalents, entitlement pay-goes are just interest on the off-balance sheet liability, right? And the Treasury spending is interest and whatever else they're doing, but basically all interest. You got to print the VIG, right? You've got to print. If your tax receipts aren't even covering your interest, you're done.
Well, if just the millionaires and billionaires would pay their fair share.
Yeah, then we're fine.
Oh, yeah, exactly.
Luke, so when I hear what you're saying, it sounds to me like an ominous cloud ahead of us. And I think back to stagflation in the 1970s, and I think of a upper middle class neighborhood like I lived in, with 3 cars in the driveway, when none of them actually worked unless you started shifting parts around to different cars. It was a different lifestyle back then, and different expectations than people had. Are you talking about that in our country for the next decade, for the next whenever?
Yeah, I think living standards are going to fall on a real basis. I think de facto. Is it a good scenario, bad scenario? What's normal for the spider is chaos for the fly, right? So, if we see rampant wage growth, as we're seeing in sort of blue collar and trades, et cetera, like that's probably what needs to happen. It's very inflationary. But I don't know what the rate is where, at some point, if they're not already, plumbers are going to make more than partners at Goldman. At some point, people are going to go, why the hell am I going to Wharton? I'm going to go to trade school. And you know what? I can leave my job at the office every day. It's great. So
by the way, a little insight. I own a bar a couple blocks away where the tradesmen all go in there at like 5 o'clock. It's fantastic. Those cats have a shit ton of money, man. They have big houses, and I don't see why we don't start telling our young men. And when my plumber comes in there, I buy him a drink. He's my hero, because you never have plumbing problems when it's not on Christmas Eve. That guy is the guy who comes in with a cape and saves the day. But anyway, that's just an aside, and I cut you off for that aside, and I'm sorry for that.
No. It's absolutely true, and we're seeing it. I mean, I have a buddy, and I'm in Cleveland, right? I'm nowhere near Manhattan or LA or Atlanta, these more expensive cities, right?
Good
and
for
you. I had a buddy who runs a landscaping business. He couldn't find people to plow this winter for $40 to $50 an hour. Can't find them. 50 an hour. So that tells you, like, there's this bid-ask spread happening. I don't want what the right number, but the bottom line is that it's another sort of imbalance we have, right? With the wage, or the trades versus sort of everything else in terms of driving some of this wage growth, some of that structural. So, and I'm not really answering your question. Are we going to have a decline in living standards? Yes. Okay. We've made a bunch of promises. Basically the US government did what AIG did in 07, 08, right? Which was, and they did it from 1938 on, which was, hey, we're going to write an insurance policy on 75 million boomers. And AIG said, we're going to write an insurance policy on subprime mortgages. And the AIG bet was that home prices will never fall nationally because we don't have the reserves to pay the claims. And Goldman's like, well, we'll lay off all our risk on you guys. And then, Goldman goes, okay, hey, pay us. And AIG's like, oh, we don't have the money. And it's the same problem, except writ much larger, which is the boomers are showing up, 70 million were born, stands to reason, 70 million would retire. Money's not there. So where's it going to come from? It's either got to be cut or, financed at higher rates, basically, right? Chase those, crowd out those global dollar markets. That won't work. It can work for a little bit, but we talked about why there's no balance sheet, or the Fed's going to print it and our living standards are going to fall. And there'll be winners and losers, but broadly speaking, living standards will fall. And I think that's the only possible way out, or most likely way out.
So, yeah, and I agree with you that when we saw the Bank of England just a couple of weeks or months ago, whenever, and they cracked and they went from, quantitative tightening to quantitative easing in the snap of a finger, it just showed me how, I was going to say ballless, but you can't say ballless on the show. How little back, I said it twice, yeah, but how little backbone, a little backbone, probably just edit that part out, how little backbone they have when their backs are to the wall. And I do think that they're going to start monetizing again. So doesn't that then start the ball rolling again, where asset prices, if they're weakening the dollar through QE, the stock market could do well in nominal terms, right? Thoughts?
I think that's where it's going, is you'll see the fiscal situation will necessitate basically them reversing course into still elevated inflation. They're going to have to start buying these bonds. And I think importantly, with inflation at wherever it is at the time, 5, 6, 7, whatever percent, when they were doing QE with inflation at 1.5, 2, 2.5, like they could make the case, well, this is just about, however they spun it, right? This is about making sure markets function, blah, blah, blah.
Liquidity, they always talk about.
Liquidity, right? Yeah.
It
was horse crap. But anyway, it was always about financing the government. But now when you're doing this with inflation, 5, 6, 7%, there's going to be no pretenses. Like you said, Bobby, the market's going to go, they're going to see right through it. And so I think it's going to be really good for energy, commodities, gold, Bitcoin, but sort of the classic inflation regime names, maybe more than what we're used to. It's under low, QE with low, with low inflation. But I think it's gonna be good for all equities ultimately.
So here's where I get a little worrisome with. I think at this particular stage, in whatever you want to call this, you want to call it a recovery, I call it a bear market, bull market, correction. I don't know. To me, this is still a bear market with a little bit of up move. When you look at a weekly chart of the S&P, you see lower lows and lower highs. If you take away that one rally in August that exceeded the highs in May, it's basically lower lows and lower highs. And that's all that's happening. From that perspective, I totally expect that we finish the fourth quarter higher than the third quarter. But what bothers me about next year so much is when I went back and looked, recessions, and I'm speaking vanilla, Luke, recessions don't hurt the stock market that much. The times during recessions that the stock market didn't perform well was when there was inflation present above 3.7%. That's when the stock market didn't do well. You add into that Deutsche Bank's recent survey showed 39% of the people, 39% of the respondents basically expect negative 10% or worse next year. How do we square that circle of the whole idea that if the Fed just cuts rates, stocks are saved, versus basically all the rain you see coming in 2023? Or can it be squared?
Well, the rain I'm seeing coming in 2023 is sort of likely to be really nominally good for stocks, right?
Okay.
I mean, what I'm really talking about is a United States balance payments crisis.
Mm-hmm.
I mean, we've seen this. I mean, it's Argentina with U.S. characteristics.
You think that could end up being good for stocks?
Yeah, I think it will be, just nominally. I mean, I think
Nominal.
at some point in the second half of next year, we end up with CPI closer to 10 than to 3. And yeah, I think you'll see a vicious sector rotation within that, right? Because at 10% CPI, you don't need to pay you don't need to pay a premium for, friggin' Google or Microsoft or Apple when, US Steel is just, putting up better earnings growth, right?
Sure.
So I think you'll see a vicious sector rotate, and that's what I mean by that. But it's this, to me, the big gear for next year, and it's very, very binary, to be clear, right? There is not the global balance sheet there to finance the deficits. So one of three things has to happen. We need to cut the $900 billion defense budget by probably 2/3 in the middle of a war with Russia, a Cold War with China. No. Or we can slash the $2.93 trillion we're going to have to pay boomers next year. No. Or we're going to let these, entitlements, treasury, defense spending, which will be about 120% of tax receipts next year, assuming like a really tame recession. We get a bad recession, could easily be 140, 150% of tax receipts. We say, screw it. Fed keeps QT in, and basically you end up in an environment where Treasury's trying to sell between 2.5 and 3 trillion in deficits. Fed's going to place $1.2 trillion in QT. Foreigners who are trying to defend their currencies against the therefore rising dollar are dumping treasuries even faster than they did this year, which they've got 7 trillion for sale all in, 3.5 trillion FX. So let's say they sell half those FX reserves to defend their currencies. There's another 1.5. So you're talking about 2.5, 1.2 is 2.7, another 1.5 for foreigners. That's 4.2 trillion in effective treasury supply. There's no balance sheet. So what's going to be the result? You're going to see a nonlinear rise in the dollar, and you're going to see a treasury market collapse again, like in a slowdown, like you saw this summer. That was not a freak accident. And that's going to blow people's minds. And the economy, and that puts you into a US classic emerging market death spiral. Rates up, dollar up, receipts down. Okay, that's option 2. Or option 3 is that will come probably after they see enough of the whites of the eyes of option 2. Like the Fed's talking tough, and option 2 is what they get if they take this too far. And that will scare the crap out of them, because to your point, they don't have the backbone. They can't have the backbone because they can't let the treasury market break. Option 3 is the Fed's like, okay, Bobby, what you were saying, wage inflation, we're going to raise our target, or there'll be some sort of bullshit excuse, right? Hey, we, treasury market functioning, or raising our inflation target for the good of American working man, blah, blah, blah. It's all horse shit. They will be monetizing the deficit to prevent option 2, which is Armageddon. And so to me, if the markets are going to be down, I think it'll be early next year where you'll get the start of Armageddon, and the Fed goes, oh my God. And it could be really hard to trade, because it could be, oh my God. And at some point, oh my God, that will just be what the Brits just did at the end of September, which is, oh my God. And they draw a line on the markets. Fed goes, that's it. That's as far as it goes. And at that point, we'll go from the release valve or rates and the dollar moving higher to we're putting a cap on rates and the dollar, and the release valve will be the balance sheet. The dollar goes down, rates do whatever they do. Treasuries could nominally actually work. But they're not going to be a very good expression of that trade, because gold's going to go nuts, oil's going to go nuts, inflation's going to go nuts, US steel's going to go nuts. And then you get that vicious sector rotation, I think, where, sort of old, if you're going back in time, right? You remember the old discussion, 99, 2000, right? Old economy, the old economy is going to do great. And the new economy is going to, I think it'll do fine, but it's just, like I said, you've still got some valuation there that, like, you won't need to pay up, because inflation will be so nuts that all this old economy shit will be doing great.
The reason I'm laughing right now, Jimmy, is because the transitions to these things becoming normal. Like, I see us 3 years from now talking about yield curve control like we've seen it for the last 25 years. Mm-hmm. It was the same thing when QE started, basically in 95, 96, and then it became the norm after the Great Recession, where QE was just a thing. It wasn't just Japan. Everybody does it. We just do it. It's just a normal thing. We go QE, QT, and fuck QT. We're going a little more. Next thing is it's going to be, well, it's yield curve control. They do that to, and all these things become normal. And we sit here on our keyboards buying Apple. It's like, it makes me nuts. It's like these things are critical, and they just keep spiraling.
And do you think, I was about to call you Brent. Do you think, Luke, do you think, Luke, that the government has any clue what they're doing? I mean, just to think of just in the last 6 months, the $1.2 trillion infrastructure bill, which is just hitting, just starting to get spent right now. The Inflation Reduction Act, highly inflationary piece of legislation. Talking still about creating debt to just pay off student loans, and there's still forbearance payments on that. Do you think they have any clue, or do you think there's a sinister plan that they want inflation to keep going, considering they're the most enormous debtor in the planet by about a factor of 100?
I think you have to separate the US government broadly into two entities. And there is sort of the MMT entity in sort of the policymaker, right? Which is like sort of
That's
the layout.
all of them, in my opinion. They're all MMT people. But anyway.
But so it's like, that's like, and it's interesting because this is an interesting, unusual bedfellows, right? So you got Lael Brainerd and sort of her wing of the Fed and policy, right? Which is like, MMT. Okay. You have the US military and parts of the defense and intelligence establishment that recognize that they are being asked to be ready to fight a war against China when the dollar system, which necessitates sort of the primacy of the treasury bond, means that our defense base has been outsourced to China to support the bond market. So they recognize, or at least parts of the defense establishment recognizes, that actually the dollar is a national security threat to the United States as structured. And so they actually don't mind the MMT thing, to the extent that like they don't want to lose dollar reserve status. What they want to do is kill the treasury as primary reserve asset, because that ultimately, as long as treasury is primary reserve asset of the world, we're never going to reshore enough stuff here. We're basically going to be dependent on China to build the weapons for us to face down China, which is, of course, a stupid strategy that won't work. And so military knows this, and sort of the MMT wing of the political side and the Fed side, Treasury side, they understand this. And that's sort of one side of our government. The other side is sort of what we hear from Powell and Larry Summers and Bill Dudley, which is what I've taken to calling the make bonds great again wing of the Fed, right? Right, which is like, hey, just keep raising rates, like starve Americans, blow up the economy, whatever it takes. We have to stop inflation to save the bond market. And like these guys are living in a fantasy world that, this is still 1999 or 98, and it's the cover of Time magazine with Rubin and Summers and Greenspan, the Committee to Save the World. There's 98, the United States government was running surpluses. The United States was the only power in the world. The Soviet Union was on its ass. China was not existent. We had debt to GDP of 50%. Like literally, we still had a defense industrial base that hadn't been sent to China. It is a completely different world. And these knuckleheads are still going, well, Larry Summers, we might need to take rates to 6-7%. If we have to take unemployment to where, like, they don't understand that's over. That world is over and done. It was fun, great, but they still have a lot of power. They have a lot of money. They have a lot of influence. They have a lot of politicians who are also living in the past who think that's still the way to do things. And like, look, if you didn't want inflation, you shouldn't have sent all your supply chain to China. You shouldn't have invaded Iraq. You shouldn't have bailed out the banks. You shouldn't have done Obama. You shouldn't have done all these things that you have done. These things have costs. And those costs are often deferred. They don't show up, and then they do show up. And here we are, right? It's like, the 70s inflation. What was that really about? They shouldn't have fought in Vietnam. It was friggin' stupid. It was stupid. 70s, a lot of that inflation was basically the marking to market of the stupidity that was spending money in Vietnam. A lot of the inflation we're seeing now is the stupidity that was invading Iraq, that was bailing out the banks, that all QE, all of it. And so these guys are sitting there going, well, if we just take rates to 6 or 7 and crash the economy, then it'll be okay. We can make bonds great again. No, you can't. The United States Treasury will default on your bonds if you take rates to 6 or 7, because tax receipts will collapse. Debt to GDP is 130%. You're at the peak of the cycle, and U.S. deficits are 7% of GDP. Volcker, you're high. You can't run the Volcker. Volcker left. The Volcker playbook has left the building. So you've got these two sides of Washington that are basically at war with each other, right? It's almost like, Platoon fighting over control of the soul of the American economy. And I don't know who's going to win. Like, I know who's going to win in the end, because these guys can talk tough, but the second their treasury bonds get threatened with default, they will fall right in line with the military and MMT. But between here and there, we're into this, oh shit option 2. And then, okay, guys, print. You've got to scare Bill Dudley, you've got to scare Powell, you got to scare Larry Summers into recognizing this. math. It's just math.
Bobby?
So I already know the answer to this question, but there's no way to grow out of that. I mean, they're just the numbers are too great. You can't sort of like hack away at regulations and keep it. There's no way to grow out of it because you spike inflation further than it already is. I mean,
Yeah, you need a productivity miracle, right? So if we, people ask me that all the time.
Productivity's down. So
productivity's down, and oh, by the way, the productivity of healthcare for an aging society is very, very low, right? Until you get some sort of technological, which you can't do because so much of your employment is tied to caring for those people, right? It's a chicken and egg problem. So if we woke up, and Christmas Day and the military came out and said, hey, we have portable nuclear fusion boxes that we're ready to roll out in 2023 and commercialize, and basically energy is going to be free for America and then the world, we can get out of it. That's the type of productivity. Or, another sort of de facto productivity increase. Hey, we've gotten regime change in Russia and we've replaced Putin with a guy like Yeltsin who is willing to sell out his country to Western interests. And we're going to get free oil and free lithium and free everything else Russia makes for the next 5 years. That's a de facto productivity increase. I don't think that's going to happen either. So barring some sort of massive productivity increase, you can't grow out of this. Once you let debt to GDP and deficits to GDP get to where they are, you got to inflate out of it for a while. There's just no other way around it. The bond market has to take the loss on either real terms or nominal terms. Those are your choices.
So I have a two-part question. First, what's your sleep regimen and the weekdays? Do you have to take something to sleep? Can you turn that mind off, or are these thoughts firing through your head like a goddamn pinball at midnight on a Tuesday night? And I honestly want to know the answer. I'm only half joking with this.
It depends. My sleep regimen is very it's very regimented, actually. It is. I'm usually in bed every night by 11.
And you don't take THC or Ambien or melatonin or anything or vodka.
No, you know what I
take all four of those things, by the way.
I've got a 90-pound kettlebell, and I will deadlift that fucker, and I'll do 100 push-ups, and you do that about 2 hours before bed, you're gonna sleep. I promise you.
I love that. Okay, so, good. Yeah.
There are times when I do. Well, I'll get up at 4, 3, and it's like then. And now it gets going.
That's the worst.
I know.
We all have it, not to Luke's level, but we all have it. You wake up
so
and
hard
you're like, what's being released today? And it's like, no, I'm fine.
No, I'm fine. I've got a notepad by the bed. That's how I get around that. You put a notepad by the bed and you roll over and you write down whatever the thought is. And half the time I can't friggin' read it in the morning, right? Because it's like dark and it's chickens. But anyway,
at least you went back to sleep. Yeah.
But you go back to sleep because it's like, okay, I've got it down, and then you can wake up and do it because I like that. That's the other thing. The other hack I've used is like I have to have that there, otherwise I won't sleep.
Okay, so now here's my question that's back related to markets again. So I've given 2 speeches in the last 2 months, and my thesis that is copper. It was actually copper over gold. I wish I'd had the conversation with you a couple months ago. And my thesis involved, the copper's price being currently depressed by the lockdowns in China, and whether or not, they're really genuinely providing the demand or just the market thinks they'll provide the demand. I don't care. You know what I mean? I care that when they start to open up again, buying begets buying. And I thought copper was the play, and it's been good so far. And I think you'll agree that it's a play, but you think that it pales in comparison to the play of gold. Is that correct?
Probably, but the timing is tough for me. Like the easier way to play it is copper over TLT and gold over TLT, and then just go to, and then you'll go to the beach.
Okay, and I meant to put in the part of it too, is that the Green New Deal, because they still keep their deficit spending and they want to spend, and whether it's bullshit or not, and Bobby and I both think it is a high degree of bullshit. But it still exists, and It's our job as traders to take advantage of it. Does that play a part? Do you think they still keep moving forward, with the climate thing?
Yes, because I think the climate thing is. I'm going to be careful here because I will get canceled. I've been
canceled. It's fine. It's fine.
I say whatever you want. Nobody watches this. Don't worry about
it. I think at least part of the climate thing is peak cheap oil and peak cheap energy. In other words, if you come out and say, peak cheap oil, the bond market crashes. Oh shit, right? I mean, you're seeing central banks leave treasuries for gold. Like in the last 8 years, central banks have bought 300 billion in gold and they've sold 400 billion in treasuries. But if you come out and say climate change, and you know, warm fuzzy electric vehicles, you know, blah blah blah, that's investable, right? No, by the way, you can slap an ESG on it. You can print 60 basis points on, you know, a couple $1 trillion if you're Larry Fink. It's awesome. So
Yeah,
I think at least.
nice.
I just wish they would do it different. I just wish they would do it differently. I mean, obviously there's a problem with climate. Obviously there is some level that we can adjust to it, whether or not that makes a long-term difference or not. I believe the jury's still out. You know, it drives me crazy when somebody says, well, you're a climate denier. Absolutely not. I'm not. There's a change. I live in Florida. Ian was a nightmare. And it's interesting because the number of storms in Florida are actually dropping, but they're higher intensity, the ones that hit here. And I'm only here 2 years and I act like I'm a fucking hurricane expert, but that's because I've seen 3 since I've been here. But the interesting thing to me is why somebody doesn't say, buy Tesla, it's an American car, it goes really fast. Oh, and by the way, the air's cleaner when they're done. The rest of it is kind of above my pay grade. What are they going to do with the batteries? All of that. Hell, I don't know. I'm not that young. I'm not sure I care that much deep down. But this idea that you can force a certain amount of the population to act on something because of the quote unquote science they tell you is settled. We've seen a number of examples in the last 2 or 3 years where that gets people's kind of guard up. That's the nicest way I can say it. And again, since nobody watches this, I guess I can say whatever I want.
and at the end of the day, you know, to your point, you know, Jim, is they're going to do what they're going to do, but it's great demand for these metals. And that's a theme we've been on for a while is anything related to electric vehicles because not only is the demand side good and the electrical infrastructure, but oh, by the way, like the supply side, like these ores are depleting rapidly, right? I mean, the amount of ore you got to take out of the ground to find a ton of copper now versus 10 years ago, 20 years ago, 50 years ago, it's rising exponentially. So, yeah, I think it makes a lot of sense for these metals broadly. And that's why I say, is gold going to beat copper? I don't know. Is copper going to beat treasuries? Yeah. Is gold going to beat treasuries? Yeah. Is lithium going to beat treasuries? Yeah. And that then gets it ties into this whole point that Zoltan's been making all year, right? Which is countries are going to start reserving commodities. Number one, you know, they can't take your pile of gold or your pile of copper, your SPR in your backyard and of oil or your lithium. You know, they can go like this and freeze your treasuries, and they did.
So let me take that theme out. We're running out of time. I know Jimmy's got to go run the restaurant, which means he says hi and drinks at the bar. But from a perspective of, so I'm an energy guy, right? I mean, I trade everything and I dabble in everything. Jimmy is definitely stronger in interest rates, and I'm definitely stronger in energy. I'm also stronger in bench press. So when you look at something like, I have to throw that in almost every show.
It's not true.
At least from a perspective of crude oil, okay, just crude oil specifically. Obviously, to get that copper out of the ground, we need fossil fuels. You're not going to get a solar driven mine anytime soon. And about when crude oil was trading about $92, I said 65 before 105. And again, people went nuts. It was a technical call based on my partner, Mike Arnold's long-term view. It wasn't a fundamental call. I almost didn't say it because I didn't believe it, but I said it. I'm getting a lot of credit now on Twitter for having made that call. I actually bumped it up to 69 with, I don't know if you know Shy Girl, Tracy Shukart.
Yep.
She was on our podcast and she complimented me on it. I'm like, it was actually 65, but I was scared to say it. The copper story, I believe, and I think Jimmy's case for it, if you see any of his speeches where he talks about it, is phenomenal. It bolsters my long-term view that crude oil is probably going to hit about 175 at some point, with the shrinking desire for capital investment in it and the increased need for it just to electrify. I mean, there's no way around those things. Am I wrong?
No, you're not wrong at all. And it's, you know, and people usually don't touch on this, but, you know, people say, well, demand is peaking in the West, right? You can see, yeah, okay, great, fair. But they don't follow up with the second point, which is China alone. As much as China's grown, China's per capita consumption of oil in 2021 was still 1/5 the United States. India's is like 1/10. Africa is like 1/20th, right? So I'm not saying they're going to use as much as we are, but like, what if they just go from 1/5 to 1/3? Like the oil ain't there. Like 175 to me, yeah, long term, I think that's a layup. And then that then reverberates back to me is like, if you like the long-term outlook for oil, you got to like the long-term outlook for gold, because you can't reserve treasuries in a world where oil can go to 175. You've got to reserve a reserve asset, at least on the margin. I mean, you may not dump all your treasuries. You probably won't dump all your treasuries, but you'll probably go from buying 100% treasuries and 99% treasuries, 1% gold, to 20% gold and 80% treasuries, or 80% gold and 20% treasury. Who knows? But there's going to be this relentless central bank bid driven by a number of things, including energy geology realities, which are that, you know, it's harder to find, it's harder to produce, it's more expensive to produce, and emerging markets, like, they want to live more like Americans and less like emerging markets.
So if I was to take everything, and by the way, you will never ever be invited back to this podcast, just because I don't like to feel stupid ever. I like to feel I'm the smartest guy in the room, and you've blown that out of the water.
Oh,
so I'm not even sure I even like you anymore. But anyway, my question is this: if we have to encapsulate what you said into like a minute answer, let me see if I got it right. We're entering a period, it's not unprecedented. It's been precedented before in the 70s with cost push inflation that brings living standards considerably down. Or if until there's in the energy sector, particularly, some technological gains that set us on our ear. That's the two things, correct?
Yeah, I think that's fair. Is ultimately you're going to have this cost push inflation, and you've got this debt problem overlaid with that is way worse than it was in the 70s. That you need, that you need a productivity sort of miracle around energy to get out of in sort of a non-inflationary way.
Okay, so that's what will happen. We have to leave people somewhat on a good note. So we're definitely going to get that. Everything's going to be fine.
Does anybody have a problem with the title that I've chosen for this episode? At some point, plumbers are going to make more than partners at Goldman.
No, I love that. Yeah.
Title of this episode, Luke.
You guys got me going, and sometimes, on a Friday night,
Oh, this was.
We have a skill for that, by the way. We can break your guard down and get you running. I think we're doing pretty good with that. Man, what does a Friday night look like for you, Luke? What do you do tonight? Family stuff or?
You know what? My oldest boy came back from the University of Cincinnati last night. My middle boy is probably rolling up now from Marietta College. And then, so we'll see them for a bit. And then my wife and I are going to go out and grab a dinner and some drinks, and we'll hang out with the boys later. My youngest is, I don't know what he's doing. He's a sophomore in high school. So, they come and go, but they're in that cool age where once they get older, like, they're really cool.
I'm sure he's on Instatalk or TikGram, or I don't know what you call those things.
What's that?
I'm sure he's on Instatalk or TikGram or one of those.
Kids these days.
They sent something to the family chat the other day that was it was a cultural reference to Family Guy, and I didn't at first get it, and because I hadn't seen that episode, and so then they had to send it to the whole reference, and it was highly vulgar and inappropriate, but hilarious. But it's pretty cool that we can, it was the reference to Claude Debussy, which if you have Family Guy fans, they'll know the reference.
I like, what's the name of the comedian, the freaking billionaire who does all the voices?
Seth MacFarlane.
Seth MacFarlane. Yeah, I think
he's
great.
He's exceedingly funny, but I can only take him in small. For 10 minutes, but after that, he starts to bug me. But I look forward to the next 10 minutes at a future date.
Oh my goodness. Yeah. He did that movie, 100 Million Ways to Die in the West or whatever.
Yeah, how about that?
I had to pause that movie like every 15 minutes because literally I was laughing too hard. I thought I was going to throw up, or I couldn't hear what the dialogue was.
Yeah, but it's not a movie you have to watch. It's sketch comedy. It's not a movie that you need to follow the thread.
No, of course not. No,
right?
No, I was just like, I don't want to miss the next joke. I'm laughing too hard. I can't see it through the tears. And my stomach hurts. And oh my God, yeah.
Well, good. Well, thank you so much, Luke. Bobby, we wrap it up here, you think?
We are wrapped up.
And I'm trying. I asked my wife if she wanted to go out to dinner. She's like, She said no, she's tired, wants to stay home. I don't know what she's been doing all day to be tired. I haven't seen her.
Down here in Florida, we're going to a place called Celebration Park because it's going to be 79 tonight, and it's an outdoor.
I just left
bar
Florida
with
5
live
hours
music.
ago. Yeah.
Oh, it's beautiful.
Yeah.
Where are you at in
Beautiful day.
Florida?
Naples.
Oh, that's nice there. That's
Yeah.
gorgeous.
Yeah, if you ever make it down, you have to reach out.
Absolutely. Absolutely.
All right. See you, boys. Have a good weekend.
All right. Hey, have a great weekend.
Thanks
Thanks
again,
for having me
Luke.
on, guys.
That was
Thank you.
great.